Hey, what's up everyone, and welcome to the School of Personal Finance. In today's video, we're going to talk about what you should do with your retirement accounts once you leave your jobs, like your 401k or your 403b accounts. There's typically four options. I'm going to go through the pros and the cons. I'm also going to talk about some strategies that are a little bit outside the box that you may want to consider before making this decision. I hope you find this one helpful. Let's get to it. All right, so real quick, come follow me on LinkedIn. I'm posting new content daily over there. Head over to schoolofpersonalfinance.com, download the free PDF, 15 numbers that you should be tracking, and then also check out my education center. Everything in there has been created with one thing in mind, helping you become great with money. So go check it out. My quick disclosure here, none of this is specific financial advice. Make sure to consult with your financial advisor before pulling the trigger on any of this stuff. These things are complicated and the rules are always changing, so just make sure that you're doing it right, because you don't want to mess this up if you're moving an old 401k to a new one, or doing a rollover, or cashing it out, or whatever the case may be. You just want to make sure that you're doing everything correct and not messing it up. All right, so the first option that we're going to talk about is the worst option, and that is cashing out your 401k plan. Just telling them, you know what, send me a check, I need the money for it. And a lot of people actually choose this option, especially when you have a very low balance in the account. So the mindset is, you know what, I need the money right now. I could use it to pay off some credit card debt, or to pay off some student loans, or to float me for a few months, especially if you don't have another job. So just send me the money and I'll go ahead and enjoy it. Here are the downsides to doing that. Not only are you robbing your future self of letting that money compound and grow tax deferred all of those years, but you're also going to pay a 10% penalty if you're younger than 59 and a half, and you're also going to have to pay ordinary income taxes on that money. So depending on your tax bracket and everything, it could cost you like 30 to 40% right off the bat to get that money. So it is not a great option. Now, there is one scenario where I could potentially bless cashing out your old 401k account. And that would be if you weren't going to be working for the entire year. So if you have no income for the entire year and you have a small 401k balance, cashing it out, it might not be the worst thing in the world. You might actually find yourself in a situation where you don't owe any income taxes on it, because maybe between your standard deduction and any tax credits that you get, it will offset any taxes that you have due on it. You would still have to pay the 10% penalty, but to be able to get that money out at only a 10% tax rate might not be the end of the world. But again, you have to be in a very specific situation and either really need that money to survive or have a much better purpose for it. Maybe you're going to reinvest it or do something else with it where it could make sense to do it. But 99% of the time, cashing out your 401k prematurely when you change jobs, it's usually a terrible idea. And now the second option is to just leave it with your previous employer. The nice thing about this is that it's simple. You don't have to do anything. It's already there. But that can't be the only reason. So what are some reasons that you would want to leave the account with your previous employer? If you have a great plan, like for example, if you have great investment options, if you have very low cost funds, index funds, Vanguard funds, great target date retirement funds, that could be a good reason to leave it there. Or it might have a high fixed interest rate option or stable value fund where you could use that as your conservative piece of your allocation, and it's going to be better than like a money market account or a bond fund that might have some risk to it. That could be another reason to keep it there. Or if later on in life they have a nice option to maybe annuitize or turn part of that portfolio into a lifetime income at high rates. Some old plans, they have these things locked into them that you just want to be aware of what they are before you give them up and move the money out from an old employer. As far as the downsides to leaving it is, it's just another account that you have to manage. It's a hassle. You have to keep tabs on it. You hear so many stories about people leaving an old 401k and then forgetting about it, or the company goes through mergers, they change retirement plan sponsors, and all of a sudden they don't know where the money is and they have to try to track it down. So that's definitely a negative to it. Also, you want to be aware your plan, depending on your balance, they might automatically force a distribution on you. So like for example, if you have less than $5,000 in the 401k plan, they might just send you a check, and you don't want that to happen either. So you definitely want to take action as soon as you leave that employer to see what your options are and what might take place if you don't do anything. But overall, most people do not leave their old 401k, with their previous employer unless there's a, significant reason to do so. All right, and now the third option, which is probably the most popular option, and that is rolling it over into your own IRA account, your individual retirement account. And if you don't have one, you could open one up at any of the big brokerage houses. So like some popular ones are going to be Schwab, Fidelity, Vanguard. So you go ahead, you have to fill out some paperwork. You want to do a direct rollover, direct transfer to those custodians. So you fill out the paperwork and then they will go ahead. Your 401k plan will send a check directly over to the new custodian where you are opening your IRA. So now the reasons that people move the money into an IRA, the biggest reason is for the flexibility and the investment options. So when you have money in an IRA at a custodian like Fidelity or Vanguard, you have complete control over what you could invest in. So you could choose very low cost index funds, you could invest in mutual funds, ETFs, individual stocks, you could manage the portfolio yourself, you could have somebody else manage the portfolio for you. It just opens up the entire world of investing to you. So very low cost options, you could choose whatever it is that you want in there, and that's what most people want to do. So a lot of flexibility by doing that, by moving the money over into an IRA. And that is probably the most popular option when people leave and they have this old retirement plan there. So now a few things you have to look out for if you do roll it over to an IRA. The first one is that with IRAs, you cannot take loans from an IRA. So if that's something that's important to you, by moving the money from your 401k into an IRA, you're not going to be eligible to take loans from it. Another thing is that if you do backdoor Roth IRA conversions. So if you don't know what that is, I have a video, I'll put a link down below that describes that. But if you make too much income where you can't contribute to Roth IRAs and you do backdoor conversions, by having money in a traditional or a rollover IRA, that is going to significantly impact your ability to do so going forward. So you want to be very well aware of that before doing so. And then the fourth option is you could take the old account and roll it into your new 401k plan. Now the determining factor with this is how good is your new 401k plan. If you have a ton of different investment options, very low cost options. If you have index funds, target date retirement funds, a great platform, then it can make a lot of sense to roll it into the new plan. You're only going to have one account. It makes managing everything so much easier. I'm a big fan of having less accounts to manage. It's just going to make everything better for you. A couple of other advantages are that you might be eligible for a larger loan if you do need to take a loan. So for example, if you're just starting out with a 401k plan that you're able to roll over 50,000 bucks into it, now you have the opportunity to take a loan from that if need be. Not saying I'm a huge fan of taking loans from 401ks, but at least you have that as a lever you could pull in case of an emergency. Another benefit to doing this is that it does keep the backdoor Roth contribution opportunity available to you. So again, if you make too much money to just do a Roth contribution, by moving this money into a 401k and not into a traditional IRA, it still gives you the opportunity to do that backdoor Roth contribution. So that could be another big factor. Another thing is the 55 and retired rule. So if you end up retiring from this job at age 55 or older, then you would be able to access this money in your 401k without any penalty before the age of 59 and a half. So if you don't know what the 55 and retired rule is, that states that if you are 55 years and older when you retire, you could access money from your 401k or 403b plan at that time without having to pay the typical 10% penalty when you withdraw before age 59 and a half. So having that money in that plan, that could be an advantage to you later on in life if you fall into that of being 55 and retired. You can't retire at age 53 or age 54 and then access it at 55. You have to actually retire from that job at age 55, and then you'd be able to access the 401k plan there without that 10% penalty. So that could be another reason. Now, the real reasons you wouldn't want to do this is obviously if your 401k plan is not that good. If you don't have that many options, if it's higher cost, then the last thing you want to do is roll any more money into it than you have to. It's bad enough that you have to use that for your ongoing contributions. You don't want to add any excess money to it. In that case, it might make more sense to just contribute up to the match and then go and contribute to Roth IRAs or IRAs or whatever other options you might have available to you. So obviously you don't want to roll it if the plan is not good. Another downside could be once you roll it in there, it's just not that easy to access. So it's not like you could roll it back out once it's in there. Most 401k plans or 403b plans, they're not going to allow an in-service rollover back to an IRA. You're going to have to wait until you separate from service. So once that money goes in there, it's basically there until you either retire or you separate from service. service, and it's not like you could just take a distribution or a withdrawal from it. Yes, maybe you could take a loan from it, but the money, it is harder to access once it's in that 401k plan. All right, so that's really it for the 4 options. One thing that I didn't touch upon, but it is important and it's becoming much more popular, and that's when you have Roth money in your retirement account. So if you have some in a Roth 401k or a Roth 403b, and that could be treated a little bit differently. Like if you want to roll that over into your new employer, you have to make sure that they have a Roth option that you're able to roll it over to, but it might make more sense to roll that money into a Roth IRA. So Roth IRAs have a few different rules, one of them being a 5-year rule. So the quicker you open a Roth IRA and start that 5-year clock, the better. I'm not going to get into the details of that in this, but I will put a link to a video down below that I did all about Roth IRAs. Another thing is that with a Roth 401k, you still have required minimum distributions at age 72, where with Roth IRAs, you do not have that. So having the money in the Roth IRA, especially later on in life, could be more beneficial. Another thing, and this actually happened personally in my own life, is when you move money from a Roth 401k over to a Roth IRA, you can take out a portion of it without any taxes or penalty up to your cost basis. So what that means in your 401k, in the Roth 401k, if you put in, let's say $20,000 throughout the year, and now that Roth portion is worth $30,000, if you roll that over into a Roth IRA, you are able to take out the amount that you put into it. That $20,000 of Roth money you could take out without any taxes or penalty. So that is just another thing to think about with this. But Roths, they're becoming much more important, and as you know, I'm a huge fan of all Roth. It does depend on your situation and your tax bracket and all that fun stuff, but I will put links to videos that I've done in the past talking about Roth conversions and Roth IRAs and everything that you really need to know about Roth accounts. All right, everyone, that is it for this one. I hope that you found that helpful. Please make sure to hit that like button if you enjoyed it. Subscribe to the channel if you are not subscribed already. I will see you again in the next one. Thanks.